Okay, that's the word coming in from Rajiv Thakkar from Parag Parekh Mutual Fund. Let's move on. Let's also welcome on board A Bala then. Bala, hi, good morning. Feeling a little nervous looking at the kind of global market move that we saw. There are clearly heightened expectations or fears rather around the second wave of the virus now hitting in, London getting into a lockdown over the weekends again, and that's sure to be rattling the markets, Bala.
Yeah, good morning. Thanks for having me on the show. I think what you are saying, of course, there's no nervous per se, but having now seen a significant run-up, and there are events to watch out as we move forward, only about 3 weeks away for the US highly expected election outcome. And also the COVID, while is been settling down, of course, in India, the number of cases has been reducing. That's a report that has come for Maharashtra and few other states. But there are countries globally where we have seen, once again, increase in number of cases. That's, of course, that I would assume would probably be the trend that could exist in most of the countries. And that's what being expected as by most of the experts across the world. But I think the significant event that I think everybody is looking at is an outcome of US election, how it's going to have an impact on the way they have done the stimulus, the way US is going to manage the fiscal issues, and also how the currencies are going to behave. Therefore, there is a bit of, I would say, the risk-on trades which has been coming for the last 6-7 months, driven by high liquidity, and TINA factor was playing a role because interest rates were pretty low. Therefore, there is no alternative to equity kind of investment concept also came in. But at this point of time, probably the correction is largely on account of that, which in my view is always good because one-sided market, especially when fundamentals are still to catch up, these kind of corrections will always bring in the necessary balance to the market and also weed out the fence players so that market doesn't become a bubble if it continues to rise.
Bala, the big talk in the market is that while there's no denying that IT is a great bet long term, but in the near term, to play on the beta, is it time to take that tactical call to move out of perhaps IT and pharma and take a look at banks or some of the infrastructure plays as well? Because in the economic normalization trade, it's these sectors which would actually stand to benefit and perhaps recover faster because IT is a well-known, over-owned story with extremely rich valuations.
Yeah, I think while interesting trend, there is absolutely no doubt. I think the way we look at, in fact, both the pharma and IT as a sectors, we as a fund house, even our own research teams have identified much in early stage post-pandemic as the two sectors will be the significant beneficiary post the COVID period. So one, because of the increased focus that could come on the health, and second, the whole digital technology is going to play a role in bringing in high level of automations, and also the need for upgrading the technology capability by most of the organization. These were the primary reasons because of which these are running. At the same time, while they have run up, I think one has to also look at it in the context of the overall growth expectation for the economy. And within that, which are the sectors can deliver better performance within the constraint that is there for the overall economy. In that context, if you see pharma and IT, the balance sheets are strong, no leverage at all, high cash companies, and these companies continue to grow at certain rate of growth, at least about 12 to 15% kind of growth, which is substantially higher than the nominal GDP growth. So that is being the case, the ownership will remain, the focus will remain. Of course, volatility is a function of the flows that comes in the form of ETF flows and so on and so forth. In my view, one should not get too much worried on the volatility, given the fact that these sectors have got a longer-term sustainable model, the way I think these companies have been built all these years. Having said that, the financial service sectors, as you rightly mentioned, while they are become attractive from the valuations point of view, we have to still look at the end of the day, the way we all perceive banking sector as a proxy to the economy. So when I mean proxy to the economy, if the GDP does well, GDP growth comes back and spending starts happening, and then the credit starts picking up, naturally, the banking as a sector should do well. In the absence of all these factors, to what extent they can becoming a skimming buy is something one has to see it. But having said that, there are companies within the space that will become a stock specific, more bottom up fishing, purely on.
Fair point, Bala. Bala, good morning. I'm just going to interrupt you here. Good to connect with you and good to see that you're back at office. I can recognize some of those wall paintings and other things which are part of your cabin. Bala, my question is, right now the mutual fund industry is getting criticized for underperforming the index. What is the plan to come back? Because the whole objective of a mutual fund industry is to generate market beating returns. And I'm not talking about the Nifty 50 benchmark schemes. It applies also to some small and mid cap schemes where there is no compulsion of reliance. What is the plan to come back?
Yeah, I think the way the money managers have also been managing Nikunj, when I used to be a money manager, this challenge always used to come for most of the money managers at intermittent time period. And definitely in the last 2 years, a significant overweight coming for certain sectors or stocks did create that kind of underperformance for the money managers, not just only in India, even globally. Most of the money managers actually manage funds and globally do not own FANG stocks as much as it is there in an index. Therefore, they're underperforming. When the broad market starts getting better, naturally, the money managers tend to look for companies that can potentially deliver better return than the index performance. So that is the way the outperformance always comes. So money manager focus will always remain for the whole industry. I would talk about even for us, will remain more of bottom-up stock finding that you try to do other than Sensex companies and Nifty companies. Having said that, even the Nifty Sensex company, which has got a great value to be generated for shareholders, one has to own sufficiently in those stocks, though one cannot own the entire index weight, given the regulatory limits in which we all operate. But that's not a constraint that one should see it as a constraint, given the fact the market breadth is also very large. So money manager, I would assume, given the fact that we have seen, I think if you look at the last 6 months, the small and mid cap index moved up by almost 2.5 to 3 times than the Nifty or Sensex in 6 months period, though it's a too short period to take it. But that's the power of the sectors. When things get better, the power of these stocks to give a outperformance to the broad market or Sensex or Nifty is substantially higher. That's the way historically it's functioned. So that's the way I think money manager will focus in terms of giving the outperformance. And it's not just India trend, it's a global trend. And the US has gone through this between the active managed money managers and the passive money managers. But the active management still is about 50% of the industry size in the US. And given the fact that the concept of generating alpha through an active management remains as one of the strong case for investors to keep their confidence still on them.
Bala, what have flows stabilized? I'm asking you industry specific questions today because again the view in the market is that domestic institutional investors are getting redemptions on a daily basis and the pillar is now shaking because compulsions are forcing them to sell stocks which they would have not sold otherwise.
I think if the way I analyze the trend of the flows into the mutual fund, after 2018, 2019, and then since the time the COVID happened, the redemptions kept rising. But the market fell in the month of March. It's known fact that it shook everybody. The confidence got lost for most of the investors, including the policymakers across the world and including India. So we saw some redemptions coming in as the market starts picking up for about 1 or 2 months. We saw actually the rate of redemptions rising. Then we saw the rate of redemptions coming down in the month of September. This is actually the function of the past return and the base of which investors try and either move out or they adjust the portfolio in order to get to better schemes. So that's actually normally that always happens. But I think given the size of the industry, which is close to about 11 lakh crore size, in that 3,000 crores, 4,000 crore redemptions per month, if that's the number that's coming in at this point of time, it is not very significant and it's bound to be there. And given the fact that we have seen a huge amount of volatility and markets has come back quite smartly and sharply, and therefore it's bound to be there. But this cycle, we have seen in 2008, 2009, For some period it exists. I think people start realizing the factor of Tina factor. And ultimately, from investors' point of view, they have to take a call. Where do I go if I sell my equity or fixed income, any other asset classes? If that where do I go options remains very limited, and then actually it makes you think, come back into the equity, keeping in mind the longer term equity as an asset class do well. And that's the way I think, in my view, I think the cycle will behave. At this point of time, I would assume kind of the trend which was rising trend in the redemptions, at least the September, October number I can say, then October was lower than September. September was relatively at par with August numbers, which something I would say it is actually is going down. Plus also we have seen some kind of NFOs good collection that's coming in. Also means that there are people in the country, mutual funds have got only about 2.5 crores investors, unique investors. And in a country which is investable population, I'm assuming it was say 30 crores investable population, 2.5 crores again 30 crores investable population, very, very small. Therefore, many new investors also will start coming in into the mutual funds once things get stabilized.
Great to have you on the show today. Thank you so much for taking the time out. We'll slip into a very quick break on that note. This was the perspective coming in from the mutual fund industry. But after the break, we'll talk about the surge in the retail participation in the post-COVID era. We'll have Nitin Kamath from Zerodha as well as Vijay Agarwal from Angel Broking join in up next.